Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On the call today, we've got Salih Yilmaz from his usual perch over in Dubai, swinging over to London. We've got Will Hares coming across the pond over to New York. We've got Fernando Valle at 731 Lexington Avenue. And we look forward to having a conversation about energy markets today. Just a quick advertisement before we get started. Fernando is going to be joining Salih in the Middle East next week, and they've got an event in Dubai on Monday, the 29th. They've got another event in Abu Dhabi on the 30th, and I think they're generally quite keen to meet anyone who's in the region. So if you don't know either Salih or Fernando and you want to say hello in person, please ping any of us here on the call, and we're happy to make sure you get connected into the events they'll be hosting. I would also flag that Fernando, myself, Mike McGlone, our colleague Jason Miner are hosting an event in Miami on February 13th. That's a Tuesday, so just a few weeks out. If you want to join us for that, also give us a shout, and we're happy to get you connected with what's going on there. So today, I'll just do a quick commodity check-in. It looks like Brent's flirting with $80 a barrel. European carbon is 65 euros a ton. European natural gas in range of about 30 euros per megawatt hour. So let's just do a quick round robin on the commodity front. Fernando, we'll come to you. When you look at the screen today, what do you make of where oil's at?
But that dueling narrative of, we're potentially losing supply from geopolitical disruptions, U.S. shale slowing down. All of those are true, but at the same time, can the consumer afford those elevated prices that come from lower supply? And we continue to think that without some respite on the consumer side of the equation, the answer is no. The higher interest rates are reflected on really poor numbers on real estate activity, on auto sales. It's more anecdotal than concrete, but there have been 3 used car dealerships, including Vroom, that was a big startup at one point, that have announced closures just over the last 2 weeks. Freight rejections still at a very elevated levels. Really, the big thing that's helping in the near term is outages in the U.S., but that's obviously temporary because of inclement weather and then these additional geopolitical risks. We think as those go away, we come back to feeling all the pressures from demand on oil prices, not just in the U.S., but globally.
Will, let's come around to you. I know we're all sort of kindred spirits on a lot of this stuff, but when you look at Brent, how are you thinking about the sort of broader macro on oil at the moment?
Yeah, I think in the near term, it's pretty reflective of what Fernando has gone through. Obviously, we're seeing a lot of gyrations on, flaring geopolitical risk in the Middle East, although we haven't seen too much disruption yet, just increased, shipping costs with increasing amount of tankers going around the Cape of Good Hope down in South Africa rather than versus through the Red Sea. But and we've been saying this for a while that unless we see a significant escalation within the Middle East, with the U.S. and the West more directly confronting Iran, then it's unlikely that we're going to see material production capacity disrupted, and as a result, then likely to see more pressure as the global economic rebounds is quite sluggish. Though we have flagged potential for that to turn around somewhere around mid-year or maybe later in the second half as the impact of Bank of England and Fed and ECB cuts start coming through.
Okay, Salih, let's bring you into the conversation here. I would just note that you've got your oil fair value model, which is a scenario quantitative framework that is available on the terminal. So tell us about kind of how you're thinking about the oil market, perhaps in the context of this tool that you've helped create.
Sure. So, I mean, I think Fernando and Will covered it pretty well. Some of the things that we're watching, of course, the events in the Red Sea. I mean, geopolitical risks have been quite serious and rising. But as Will said, we haven't really seen any disruption really. So I think that's perhaps why the market has been complacent, maybe. But then at the same time, so that's on the geopolitical side. We are watching China's efforts to stimulate the economy. Of course, the weekly US inventories data that Fernando follows very closely and writes on as well. But I mean, overall, I think the markets do seem to think that, one, as Will said, there won't be a wider war in the Middle East. And two, the markets do seem to be pretty well supplied, at least in the first part of the year, in the first quarter and maybe second quarter of the year as well. So on the fair value, I mean, we published this note last week, the latest update, and our fair value from that model was around $80 a barrel. So I do confirm that, I can confirm that the model works and markets are efficient, because that's exactly where we are today. I mean, joking aside, I mean, this is a scenario analyzer, and it is a multi-factor regression, and obviously we're playing around with multiple factors, including but not limited to things like the geopolitical risk, which we've been increasing in the last couple of updates, refining margins, inventories, market sentiment, and inflation expectations. So I think, I mean, of course, moving geopolitical risk up is quite bullish for the fair value, but at the same time, I think the sentiment, the macro sentiment has been quite weak for a while. So we've been adjusting that down as well. So yeah, that's it from the fair value
Okay,
model.
thank you, Salih. Perhaps before we get into looking ahead at kind of getting your views on 4Q results and some of the read into equities, Will, I want to come over to you because BP has finally decided on its new CEO, and for anyone that hasn't seen it, we'll put out what we describe as a React. If you don't know our React product, anytime there's big news at a company or related to a commodity, we put out a React, which is our sort of rapid fire analysis to try and help frame what it might mean for the underlying company or commodity. So, Will, over to you. Tell us what's going on at BP.
Yeah, thanks, Rob. So BP last week has just confirmed that their interim CEO, who was the prior CFO of BP, Murray Auchincloss, they've confirmed him to the full-time role, which really has corroborated our longstanding view as to who would be Bernard Looney's successor. And this came after his sort of abrupt resignation in September of last year, which followed some allegations and that he had not been entirely forthright with the board about some prior relationships with staff. And so I think this confirmation really helps the company move on first from this leadership uncertainty. There had been some rumors sort of swirling around that this made BP a more attractive acquisition target. I didn't really give too much credence to these. First off, we hear this every now and then, and second off, I think any acquisition of this scale of BP would likely hit some major antitrust hurdles as well. But on the benefits of the new leadership, Murray is well known. He's a BP veteran. He could be viewed as the establishment choice. He's well liked by investors as well. We think that the impact will be, firstly, a limited deviation on strategy here. As the prior CFO, he was a key architect of BP's current strategy, and so we think that it's a stable, reliable hand on the wheel, so to speak. And keep in mind that the BP strategy was dialed back on the energy transition roughly a year ago, where the company increased their capex in oil and gas, and flattened their a projected hydrocarbon volume decline to 2030, which was viewed very positively by the market. It was a much more returns-focused strategy, which is what a lot of investors have been looking for after the widespread consensus here is that Europe's majors have gone too far and excuse me, and too far and too fast on some of their energy transition strategic outlooks, which has risked returns and in part contributed to a pretty wide valuation discrepancy between Europe and their American peers, Exxon and Chevron. But still, we see that the new CEO, Murray Auchincloss, he's got a full inbox that is replete with challenges here. BP has been a heavy underperformer within the Western global energy major peer group on both share performance, on total return, on return on average capital employed. We also think their balance sheet is among the worst of the group, with elevated net debt and relatively elevated leverage compared to their peers. And I think this energy transition pace needs to be importantly clarified from this new leadership, particularly given some of the I think you could call it a sort of volatility and swinging around of their strategic vision that has occurred in the last several years. And I think BP's investors and board and employees are looking for some stability after what most market watchers would say that has been a pretty volatile last decade or 2 decades for the company, particularly in comparison to their larger European peers, Total and Shell.
Well, I'm curious. So, if you look at Brent Crude over the last year, obviously some ups and downs, but pretty sideways. If you look at the MSCI energy segment index, pretty sideways. Again, up and downs, but like pretty flattish over the sort of last 12 months or so. So I'm curious. One context for the new CEO is, what's going on with the commodity price backdrop, and is $80 a barrel comfortable price range for BP, and how does it compare with some of the other European oil majors? Do they need higher prices to get excitement about their dividend story, capital return story, and so forth?
Yeah, I think $80 is a perfectly comfortable place right now for most of these companies. I think distributions remains the name of the game for the Europeans, at least. We're expecting to see slightly lower buybacks this year than we saw last year. BP and Shell still have their dividend policy significantly below where it was prior to COVID-19, and so we expect continued dividend growth here. But I still think that as much criticism as I've just dealt to BP, I think more broadly this group is among the more attractive areas to have exposure to in energy right now. They've deleveraged their balance sheets pretty significantly. Distributions are quite high and healthy. Dividends are growing, and we are seeing slightly higher investment in oil and gas, which I think is a strong and compelling move. Adjusting that energy transition pace back slightly over the coming 5 years or so. So yes, $80 a barrel is certainly a pretty comfortable price for these guys, and but of course higher is better.
Okay, let's bring Fernando back into the conversation. Hey, Fernando, very interesting perspective from Will on some of the European integrateds, which have a pretty different take on a number of things versus some of the U.S. majors. So give us a sense. What are we going to hear when we look at 4Q and full year results for some of your names?
I think it's it's very interesting, especially with just what Will laid out on BP and their challenge. I mean, you could hear a little bit of "I told you so," but I think mostly they're going to say, "Look, we're sticking to what we said. It's not that we don't think there's an energy transition. We just don't think that it needs to be with a brand new infrastructure as solar and wind requires." They're not going to be E&I either that's saying we're going to go 80% natural gas. We're kind of going to stick to plan, and we're going to do carbon capture and liquid biofuels, especially in the case of Chevron with the latter. I think it'll be interesting to see because it's the first time where a lot of the different pods within oil are coming down. So you have upstream coming down, and Exxon already alerted that even though they're expecting more or less flat earnings, a lot of that is because of unrealized gains on their hedges. So if you strip that down, it's about $1.2 billion down on the upstream segment. It's fairly significant. It's 18-20% of the earnings. Refining down very significantly as well, and that's a warning shot for all the independent refiners. And then chemicals up slightly, but still struggling versus their highs of 2021 that we saw are likely not coming back. So all of those coming down at the same time, we're really at a place now where they're borderline with getting free cash flow that's sufficient to not just cover their dividend, but also their buyback plans. We think especially with some of the majors, it's going to be touch and go. Probably Chevron doesn't cover their buybacks, which means maybe that pace is not as sustainable as we expected. But again, in a similar vein to BP, potentially even more so, their balance sheets are in really good shape. I was just doing the number for Exxon. It's under 0.222 times 2024 EBITDA, which may be a little high, but still it's very good. They can buy through the cycle, and I think that's the message they'll deliver. We're going to make ratable buybacks even though we have much lower margins. How long that sticks around is the question. I guess it depends on whether my view on the economy bears truth or if the Fed and the Bank of England wind up cutting rates over the next few months. If they don't, then the buybacks may have to be slowed down significantly.
Okay, Salih, I want to get your perspective from the Middle East. How are your names looking when you look at the sort of 4Q and full year results, and how are they positioned around free cash flow and capital returns as well?
So I'll start with Aramco, which I think is the most important, and I think the question you asked around $80 a barrel benchmark pricing being favorable. I think it is an interesting case for Saudi Aramco because for the company it is a very comfortable price point. But then you might be asking, then why is Saudi Arabia perhaps pushing for higher prices with their OPEC Plus strategy? And the reason is, Aramco itself, very low operating costs, very efficient. They would be operationally breaking even at much lower prices. But because the Saudi Arabia economy is so dependent on the oil revenues, they need a much higher price to fiscally break even. The IMF number is in the 80s, in the mid $80 a barrel, but the Bloomberg economics team here actually adjusted for what's happened and how much they've increased their public spending, and they reckon that fiscal break-even price is closer to $100 a barrel. So just wanted to highlight how Aramco is an interesting case where their balance sheet is in a very good position. They have a net cash position. They're paying a lot of dividends, a lot of which is obviously going to the Saudi government. But they're in a very good position. And in the region, the rest of my coverage is more on the chemicals and fuel retail side. And as Fernando said, for chemicals, they're nowhere near 2021 levels. And I mean, we knew the outlook wasn't great for them, and the fourth quarter isn't necessarily very weak. We've seen some marginal improvement from the third quarter, but it does remain there is still a lot of pressure on margins for chemicals, which is obviously very important for Aramco itself as well, given it has a 70% stake in SABIC. But when I look at the rest of my coverage in Europe, some of the mid-sized integrateds, some of which also have exposure to chemicals, they're not going to get too much support from chemicals. Refining margins, we've been getting some of the trading updates from the companies already ahead of their earnings, and what we're seeing is a pretty notable drop in refining margins from the third quarter. So I think there's going to be some weakness in downstream, and of course in upstream. Oil prices, as you said earlier, they're down, not by much, but we're not going to see any significant uptick in profitability in upstream either. So from the companies that I cover, OMV is up first on February 1st, and then we'll have the rest of the group in the 2 weeks following.
Okay, thanks, Salih. Given that we're still relatively near the start of the year, it might be useful for us to talk about some of our top global energy predictions for 2024. And so, Will, I think it'd be great to have you kick off because you were the ringleader on this exercise as usual. Maybe can you frame for the group here kind of what some of the big themes that we're watching are? And I would just note that if you pull up Will's bio on the terminal, we've got a note that came out Monday, I believe, on this exact topic. So, Will, over to you first to kind of give us the sort of big picture overview.
Yeah, sure. Thanks, Rob. So I think this is our third annual iteration of our top global energy predictions this year. We went pretty well last year. I think we got nearly all of our predictions correct last year. But this year we've allocated them into 3 different buckets. It's oil, gas, and energy transition. I think we could broadly say for each of them. So energy transition, I would say the trend is one of acceleration. We have, much higher solar installations projected. That's yours, Rob, along with also higher turbine prices in wind. And mine in energy transition is, this might sound a bit contradictory to what I was saying earlier, that European majors are dialing back their energy transition pace, which they are, but they're still adding significant renewables capacity. So we expect their net installed renewables capacity to increase by roughly a quarter this year, which they exceeded last year. And I think, and also in gas, we see we've gone from a shortage of gas in Europe in the last couple of years to things looking pretty rosy and sort of almost oversupply situation now. This is with strong growth in global LNG, particularly out of the US. We see European gas averaging 25 to 35 euros per megawatt hour this year, as demand sort of ticks over, and we've got a strong supply outlook, particularly from US LNG imports. And over in the US, our E&P analyst in the US expects that this M&A wave of in the shale patch to begin extending from the Permian into the more gas-prone plays of Marcellus and Haynesville. Really like that prediction. That's super interesting. And then within oil, we have 4 predictions in oil, but they range everything from Fernando's refining margins, which I can let him touch on, to Salih's OPEC prediction, which I can let him touch on. But broadly, and as I think I mentioned earlier, we expect pressure on oil prices in the first half, and that pressure easing up in the second half as the global economic backdrop improves. Some of the impact of those rate cuts might start coming through closer to the end of the year, and the Chinese economic rebound also gain some steam. And so that's a sort of a very brief overview. But if if any of you wanted to touch on your specific predictions, I mean, yeah, be my guest.
Yeah, let's do it. Fernando, I feel like you already gave us a preview when you were talking about kind of giving your kind of full year and 4Q preview, but I think it's an interesting idea. Anything else you want to add on that front?
Well, I just think I'm the resident bear, and so I don't the part about the second half recovery is the part where I fall off just mostly because I don't think we see very pressing rate cuts. Even we wrote our previews for the EIA report yesterday, and even consensus that was pricing in a 93% chance of a Fed rate cut in March now is down to 50-50, and I think that will keep coming down as we see that inflation is now going to that 2% level, and 1/3 of it is housing, and if we don't have a significant correction in housing and its owner equivalent rent, so basically we need to get prices to be down significantly in order to get that slowdown in actually the inflation metrics the Fed looks at, and without labor and housing slowing down or actually contracting significantly, we won't see that, especially at much higher rates. And it's kind of a vicious cycle in that way. So I think we're in for more pain even in the second half.
Fernando, I want to buy a house later this year, so yeah, I'm open to your suggestion. But I suppose
my suggestion is
existing. Well, I suppose most existing homeowners don't want your scenario to unfold. I got to sell a house, buy a house, but let's see how it goes.
I own a
Salih.
house, so I'm with you.
Are you a cash buyer, Rob? That's a big question.
Yeah, but you could refinance later. Let's see. I mean, the dynamics of U.S. housing versus UK are so different, and the 30-year fixed rate mortgage thing we have here is a special outcome in the U.S. Salih, let's hear what your thoughts on OPEC are. Certainly a provocative call you've got.
So we think that OPEC and OPEC Plus is actually in a rather difficult position this year, because I think they've been banking on an uptick in demand so that they can start tapering these output cuts. Because I think when they started with these cuts and when they deepened them, they thought, demand isn't picking up, but it will eventually. So let's just keep the cuts and support prices, and soon enough we will be able to return the barrels back into the market. But what we saw with the last OPEC meeting as well, which was coincidentally when Angola decided to exit the group, was that they realized that there's plenty of supply coming out of OPEC Plus, especially from the US. And the demand indicators have not really been flashing green. And the outlook for, as we've mentioned, at least for the first half of the year, is still quite bleak. So they're in a position now where they have had to keep those cuts, and they might actually be in a position to even deepen them later in the year if the outlook does not get better. So looking back at the last meeting, a member nation like Angola probably looked at this and said, okay, there's probably not that much value for us to stay in the group. So I think there might be some tensions brewing beyond just Angola, given the Saudi Arabia, the de facto leader of the group, is pushing for these cuts because, as I mentioned earlier, they may need a higher price to fiscally break even. But there are many other member nations in the group that don't need a higher price and that are a lot more comfortable with a price that might be around $70 a barrel. So with that in mind, I mean, the bold call that I have is that we may have some of the smaller member nations, actually some of the ones that exited before and rejoined, such as Gabon, which rejoined in 2016, Equatorial Guinea, which rejoined in 2017, and Republic of Congo, which rejoined in 2018. So I think they might find themselves in a position where they're also questioning the value of their membership of the group. So that's my prediction for this year.
Okay, thank you, Salih. I'll just reiterate, Will, you've already given a preview, but on the solar side, I would just tell anyone who's watching that space that we continue to see very strong momentum in terms of fundamental demand installation. So we're probably going to install north of 500 gigawatts of solar globally this year. Go back 5 years is about 100 gigawatts. So we've 5x'd it. We're not far from talking about a terawatt of annual additions, and roughly just over a terawatt is what the installed base is. So solar is just booming, and the best in class solar companies are going to grow their top lines at 30% or more this year, based on consensus. So if you want to get a sense of kind of who's growing quickly, check out our note or give me a shout and we can talk through it. And the wind side is quite a bit interesting. They've had a difficult few years. You've probably seen some of the headlines, but we really are starting to see and expect a recovery in profitability for some of the manufacturers, and so we think Vestas is going to really lead that charge this year. And the basic story there is that demand is looking pretty good on the wind side of the equation, and turbine prices have been going up. Steel prices, a key input cost for the industry, have been coming down, so higher prices for their product with lower input costs sets up the story for a margin recovery. So broadly, that's what you got to look forward to on wind and solar this year. Again, if you follow up with any of us, we can get you that note. And I mentioned at the beginning of the call, but I think a few of you have joined late. Fernando is going to be joining Salih over in Dubai and the sort of region more generally next week. They've got an event on Monday in Dubai. They've got an event on Tuesday in Abu Dhabi. So reach out to any of us. We can get you the information on that. And if you are interested in networking with us and your sort of broader community of folks who are interested in energy, Fernando and I will be joining each other, plus Mike McGlone, plus Jason Miner, and our AppSpec Paul Reagan in Miami on February 13th. So hope you would join us in that event if you're in the region or interested in just popping and getting some warm weather. So hope everyone has a great week and look forward to being in touch. Take care, everyone.